Hello and a warm welcome to all of you. It's my pleasure to welcome you to the Investment Talk USA, What's Next for German Cross-Border Investments. This morning we started off the day in Asia, and naturally we want to see what is happening in the United States. While we are about to wrap up our first business day of the week now, our colleagues have just kicked the workday off. But this year also showed us that it is a year of struggles. So we want to let you have a look at the US real estate markets in this hour briefly, and to have an idea of what is actually right now happening to the portfolios all over the place. This market is actually a very interesting market, and it is continuously strong albeit all these issues. So it's my pleasure to welcome Mr. Leube, CEO at Colliers International Deutschland, together with his colleague Robert Stamm from the USA. You have a very elaborate round of guests today with whom you will discuss the current issues in the market. Before I hand over to you, let me just voice to all participants as well that you can ask your questions during the chat function, and the chat function is available during the entire session, but we will forward your questions in the Q&A session from minute 40 onward. So without further ado, I'm handing over the baton. Mr. Leube, please.
Good afternoon and good morning, ladies and gentlemen. Thank you very much for joining us. It's a pleasure for me to moderate this session together with Rainer Komenda from BVK, one of the biggest pension schemes in Germany, and Driss Oulkadi from Deka, and obviously Robert Stamm from our US Colliers office. Colliers currently is undertaking about 40 webinars at this time to give you a perspective of what might be ahead of us and what's next. This morning, as Julian already lined out, we had our webinar on Asia Pacific, where COVID started probably by the end of last year, and it seems Asia has the virus well under control, and business and real estate markets are coming back. So we are quite interested to see where the US stands, and Robert will give us a short presentation on the real estate market in the US. Thereafter, we will have a discussion about trends, opportunities, and risks in this current environment, and we will try to transfer knowledge from the different regions in terms of where we are going and what is ahead of us. Robert?
Thank you, Matthias. Let me start. So good morning, good afternoon, good evening, everyone. Thanks for having me. I thought first touching a bit on the COVID situation in the US and try to find the differentiator we experiencing right now. While the rest of the world is recovering or talks about potential second waves, we're clearly here still in the first wave. As you see, we have a constant up and down. It started here with the shutdown in March this year, but the best trend is the side trend. We don't really see a big recovery yet, and still struggling with the first wave. In terms of sheer numbers, you can tell the numbers in the United States based on size. Obviously, we are aiming for the 8 million cases already, but the cases per million were in the top 5, constantly trending, which is an issue. What is the issue? The main issue is that this whole COVID became a major political play. It was officially announced by the government or the president that the COVID was played down at the beginning. Therefore, there was a definitely lack in timing and response time. It was handed over to different states, the governors, down to the city level. So we can see a trend where there's definitely no consistent master plan. And this inconsistency you can tell in the holiday season in the US, in the summer spikes when people go back to the beach, the municipalities going after the mayors are discussing with the governor. So with that, we pulled a couple of data points which we believe is interesting, and comparing the major gateway cities in the US. And that describes pretty well the recovery index, which is quite inconsistent compared to the major cities, Paris, Frankfurt, London, where you have a 7 in recovery, which means it trends towards a recovery, even if there are up spikes like in Germany, we read this morning again. But if you compare the New York, Washington, we have an absolute inconsistent level, and same with back to school and back to work, where we are here in California, example, at about 20-25% office occupancy. Oops, sorry, one too many. With the nationwide stay-at-home order and shutdown in March, we definitely had a big hit in the economy. The GDP went down by over 30%. The unemployment rate spiked in April at a 15%, went back down to 8%, which all started in the first quarter around February with a 3.5%. So far, the CARE Act, PPP, and other responses from the government seem to be appropriate and worked. And the general expert opinion foresees a recovery in 2021. With that, the real estate market in general started after a 10-year peak cycle in 2019, where we reached a transaction volume of around 600 billion, pretty moderate, soft in 2019. So even pre-COVID, the US started slow, pretty much. People expected a softening. The market got too hot. Cross-border capital, especially from Canada and Asia, pulled out. So even before the COVID hit, the market softened, and obviously then with the shutdown and with the development on the pandemic side, the April 22 numbers, 2020 numbers went down by over 70% in transaction volume. Even here, we are seeing an uptick after the holiday season. We see more product in the market. We haven't seen a lot. I would say on the core side, we have about 20% of the stock, which we normally see. But slowly but surely, there is an increase in activity. Very important, which is crucial in the US, is the availability of debt. While the Fed was adjusting the rates for a while, beginning of that COVID crisis, most lenders were sitting out a bit the development, waiting for stabilization of the rates. But the last couple of months, the lending business is back, and even the CMBS market reopened, which is a pretty important driver for the US real estate capital markets business. Quickly touching on the property types, while I don't think there are any surprises for anyone in Europe, office is quite a mixed bag. Most of the institutional investors, especially with our guests here, Deka and BBK, are still focusing on office, as other foreign investors do. There is some resilience on certain office users, but the long-term discussion is a challenge. What is the footprint in the future? What is the office layout? Do people like home office? Is it efficient? A very inconsistent feedback so far, and it has to be played out and seen, but definitely a challenge, the long-term view on what really is happening and how does the footprint look for the occupier in the office sector. Industrial, definitely everyone's darling. The e-commerce pushed the demand for industrial property with COVID, no surprise, even further push. Pricing, like it is in Europe, we just talked about it with our teams in Europe, absolute aggressive pricing, easy to understand, and a lot of the institutional capital gets reallocated from retail and other more struggling asset class into industrial, which pushed even pricing more. The retail sector, also no surprise, got hit the hardest with hotels. Here already a lot of struggling at the year beginning or the year end of 2019. The big cities, the high street retail showed weakness, and it's an argument you can make that a JCPenney, a Brooks Brothers, a J. Crew, Neiman Marcus, and all the bankruptcies we've seen over the last couple of months, these companies weren't healthy, and it pushed some of them over the cliff, and some of them disappeared. And it's pretty much the one who focused on brick and mortar, which got hit the hardest, while the ones which started with an online presence and online found a good balance and are really ready to adjust their concept and should be able to make it through. The multifamily sector, the US has definitely still a shortage of affordable housing. It's a trend which continues. Therefore, it's a healthy asset class. Hotel, here we see the most tremendous shift. Even here before COVID, the hotel business was reshaping. The question here is really who can adapt the concept, who can convert partially or maybe the whole concept into multifamily, residential, student housing, or find a mix. It's all about adaptability, how adaptive the user is and how flexible the property is. But here we see definitely the hardest hit asset class, where I would say we're down by around 90+%. Due to the turmoil of the second quarter, and I would say a shock freeze of the first quarter of COVID, capital piled up, and we, compared to a 2009 financial crisis, seen an enormous amount of dry capital piling up on the sidelines. We're around $200 billion dry capital, which is allocated towards the US, waiting on the sidelines for opportunity. Here, clearly, the focus is on core opportunities, pretty much driven by supply demand. We have an extremely competitive core product bidding field. The underwriting all focused on long-term credit cash flows. We see more increased recapitalizations and expect off-market deals. A lot of the institutional capital doesn't want to sell, obviously, as the reinvestment is an issue. So we are actually, as a company, actively involved in increased recaps, refinancing, using the favorable debt markets. The foreign investors are back in the market, definitely challenged by a very difficult travel ban, which Bill, we talk about this later anyway, but travel makes it not easy, and some of the investors need to be present. There are process requirements. On the other hand, the long-term, or at least mid-term, what we see, low interest rate environment by the Feds allows now also Europeans lower the hedging costs tremendously. Even in Asia, we have investors which have hedging profits on their equity and their currency hedge. Generally, the performance year to date, outliers is definitely life science, industrial, data centers, while the office sector, multifamily, and hospitality sector, in that order, suffering from the current trends. Sorry, it's a little delay. So to come to my last and my favorite, a very difficult topic, the US election. Obviously, both parties dividing the country right now. It's a war between the parties. It's a very entertaining environment we're in. We see both presidents, potential candidates, having a very similar impact in terms of result of the pandemic and how we end up in a recovery. The forecasts see that in the 4 years, if it's Biden or Trump, we will be at a very similar recovery rate, even if the tools of both presidents and their parties are different. While obviously the Democratic Party will use a tax-driven recovery, the Republicans are more or less regulation, reduction of taxes. And with that, it's very unpredictable. And that, I think, is for my last comment, describes the solid core of the United States and the economy, while the president advises us of Clorox injections and other fancy magical things. The economy is strong. The economy will recover. We know we have speakers today which have assets held under a Democratic government, under a Republican government. Did it really impact their investments, their value appreciation? I doubt. But we are in the midst of a very entertaining debate. Next week, we might have another one, we don't know. And with that, I hope it was enough to give you a little bit of update on what we see here in the US and squeeze it all in a quick 10-minute overview. Thank you.
Thank you, Robert. Very interesting. So, Driss and Rainer, you are obviously investing globally with your capital. How do you see the US compared to other regions in this context? Driss, do you want to start?
Yes, sure. Hi together. So, being invested in over 28 countries, at least I can say that the US has one thing in common with all the countries, that it is currently suffering from COVID-19 and all its impact. If I may choose the top two items or matters which differs the US from other countries, I would say A is the inconsistent management of the current situation throughout the country. As Robert already stated, you will see, we are realizing that it is across the US from East Coast to West Coast, but also within the states, it is a different management. And while the European countries and the Asian countries claim by themselves that they have it somehow under control, I wouldn't confirm this for the US right now. And the second item I would say is the upcoming election. We don't see any other country in Europe or in Asia which at least has an upcoming election which is getting so much attention and is being put in such a spotlight as in the US right now.
Okay, Rainer, your perspective on the US?
So regarding the investment, I think we always have a super long perspective, probably not like the church, but like a pension plan. And due to that, I think our thoughts are not really led by COVID, but by long-term trends. And still the US stands for roughly 1/3 overall in the investable, let's say, grade A universe. And that's something which is significant importance and a diversification driver for our investment aims. So COVID, of course, is an issue. And obviously it looks like the US is not dealing perfectly with the whole situation, but nevertheless, looking a bit into the future, I think we all hopefully think positive that we'll have also like a post-COVID area. And and BVK, we are still a believer in the US economy. Besides these like election, Democrats or Republican, I think we have a long-term view, and that's still positive.
Okay, and have you done any kind of transactions in the period of the pandemic, or are you evaluating specific product now?
We're still stuck in a trade-off between piling liquidity and investing, and of course it's not easy in the current environment. Nevertheless, we closed some transactions also in the US, but mainly these had been transactions we kicked off last year before COVID. We got stuck in the crisis, and I think there had also been transactions we had been walking away as we could not deliver the underwriting we expected. But we are still, I think, with a much lower momentum in the market, and as of today we closed like 3 transactions in the US, and that was mainly office.
Yeah, and did you adjust your underwriting during the process then, or?
To be fair, I think all the 3 transactions had been like core transactions, and I'm pretty happy that we did these transactions, and it turned out that the market had been even stronger through the crisis. So I think there was like no way to renegotiate the pricing also in the early stage of COVID. And as I said, it's all of these 3 transactions have like longer or really long-term WALT from 9 to 15 years. And due to that, I think at the moment there's like no reason to adjust the underwriting for that. That might be totally difficult for a value add, but for a core deal, I think there's no way to do that.
Okay. And Driss, did you do any transactions since the pandemic started, and was there any kind of changing in your underwriting?
So this year we have already transacted about globally about $4.3 billion, a total of 38 investments we did. Most of them, in fact, over the initial COVID period or just recently. However, in the US, we were able to do only one transaction, which we did. We signed and closed in May in Chicago. And did this situation had any impact on our underwriting? Yes, of course. We have for ourselves adjusted our underwriting when it comes to the market rent and market growth. Same with rent abatements, TIs. But more interesting, we also have implemented a much more forensic analysis of tenants, much more than we had before. Given that we are a cash flow investor, we have to rely even more right now on a stable and secure cash flow. So while we benefit from a large portfolio across the globe, and we are getting daily updates from our asset management and from our leasing team, which we are also taking over into our underwriting, we do right now a much more detailed analysis of the tenant, looking at how this COVID situation or this lockdown in the particular country or state had already impacted the tenant itself. We could see, of course, tenants who are suffering, but also tenants certainly which having right now a benefit from this situation. And we also try to understand through different analysis and options how this could have an impact over the next short, mid, and long term before we really dig into the investment itself.
Okay, Rainer, you already elaborated that obviously 1/3 of the Grade A product is in the US. So, are there any other advantages for you to invest in the US? I mean, you have hedging costs, obviously, and are there any other drivers? Where do you see the opportunity to really invest in that market?
Yeah, to be fair, like I said, it's still one of the biggest real estate markets, and even the US. Let's put the whole COVID situation in brackets. But still, the US, I think before COVID, there was a positive momentum on growth, also on the population growth, and that's probably one of the fundamental drivers for our whole economy. So as we are seeing most of the European economies in a more elder stage, the US is still growing. That might change with regulatory issues due to Trump and what's happening to the boundaries. But I think that's one of the big markets besides Asia where we had a really positive momentum in the past. And with looking into the future, I think the big question is when. But we do still see that positive momentum will definitely come back, as we do not see any fundamental changes in the population growth and so on.
Yeah. And for you, Driss, are there any other interesting angles? I know you have done an open-ended fund on the US, I believe, in the US dollar.
Yes, that's right. So we have been now invested in the US for over 25 years, and I can just really confirm what Rainer said right now. For us, it's when we decided back then to start a global fund. Let's take, for example, our open-ended Deka global fund, and which has its focus outside of Germany or outside of Europe. There's no way around the US as the strongest economy in the world. When it comes as a euro investor, however, we were always struggling with hedging costs, given that our investors are mainly German clients or the savings banks who are just having firsthand only a euro account. So hedging costs were always a matter for us when it comes to investments outside of Germany. And we saw a significant increase in hedging costs, especially in the year 2017, when the spread or the hedging costs went up from 150 basis points to 250 basis points just within 1 year. and it just even got worse in 2018 when it hit its peak at 285 bips. During this period, it was very hard for us to underwrite a investment for the global fund or even any other German fund in the US or even in some other countries. What we did then in 2015 and 16, already seeing this trend, we have founded and started a US dollar fund, knowing that we have a lot of clients and investors or savings banks who either have a US dollar account or do also believe in the US dollar currency itself. We started it in 2016, and meanwhile the fund is about 500 million large and has 8 properties or 8 investments across the East Coast over to Chicago and even in Portland and on the West Coast, and is also further increasing it and doing more investments as we speak right now. When it comes to hedging costs, however, I also have to mention that when you look at the spreads right now, where the Euribor and the Libor are, we are seeing hedging costs at about only 70 basis points right now, which in fact makes US investments much more attractive and also competitive to other investments which we are doing. Does it mean that we are able to also invest in the US for our Euro funds? Yes, in fact. When it comes to 70 basis points, and this may even improve over the next couple of months, we are in a situation, and we have already started to underwrite opportunities for our Euro funds.
Robert, you obviously, Ryan and Driss are mainly focusing on office property. Do you see any other opportunities for international investors in the US, and where specifically in terms of the map, I mean, cities or asset classes that might be attractive and that people are not really focusing on?
It's hard to say. I thought about this while both were talking. Why? First of all, I mean, obviously, I'm a big promoter of the US by business, and having a country of that size with so many metropolitan areas where you can really have a very sophisticated and proactive portfolio management, mixing regions which are not 100% correlating, having a currency system which is the same, having a government which is stable, even if it twitters here and there funny things, but all that above, we have metropolitan areas which no other region has, that sheer number. Kansas City's office stock outperforms Frankfurt. So let's take the sheer size and the power behind this machine. It's an interesting environment. To your question, yes and no. There are other opportunities. Is this distress? Is this debt? But the question is who you are as an investor. Having 2 of the big players on that call, for Deka, you guys have a different cash-driven investment horizon and focus than even maybe BVK, which goes outside the value add and be a little bit more creative. I think what BVK did, for example, is interesting because they were able to tap on different asset class opportunities, also not driven by an almost boring open-ended fund view on year X. I need the cash return. I cannot go off. It's an appraisal issue. So there's so many different reasons why. If I would be Blackstone, yeah, I would sit on the sidelines with my billions and wait for blood in the water, and there might be some. I don't think that Driss will have that of a patience and the whole fund to go that route. So I think it's really driven, and this is traditionally with especially German investors, they stick to their guns, which on the other hand helps them in a long-term trend to always win. It's the discipline, it's the long-term view, it's maybe a little bit the stubbornness, but you stick to your guns and you win long-term. The short-term plays didn't play out for every offshore investor, which maybe are even more on the Asian side, where it was tested maybe too much and money was burnt. But therefore, I think what Deka did by going into a dollar-dominated fund, exploring new cities, not going off the beaten path, sticking to really credit tenants in prime pitch locations, and the same with the BVK, having a very interesting, more maybe more creative outfit. But again, you know better than I do, but your money is invested differently, and you have a very long-term, very clear path and when you need your money, while Deka has in and outflows they have to be careful of. So it's really dominated by the architecture of your fund and your capital stack. So I know it's not the right answer for you, but it depends.
Right. Do you see any opportunities? Because as Robert says, you are not only active in the core segment, obviously, and do you see any opportunities for you that arise in the US market?
Yeah, to be fair, I thought Robert is totally right, but nevertheless, I think we are not so different from the Dekas and the unions of the world. We still sit on a 90% plus core portfolio, which of course gives me the flexibility and the room to dig a bit into more risky patterns. But nevertheless, I'd say for us in the current environment, it's a bit too easy to dig out the kind of opportunities probably we would look after, as I'm not pretty sure how my underwriting would look like, and it looks like at the moment there's still a mismatch between the buyer and the seller, and that's probably a bit too early to really chase opportunities. So I would give the market still like a quarter or half a year, and we might see more next year.
Agree.
How do you guys cope with the travel bans and doing doing investments and evaluating products? What's your plan to overcome that, and how do you do business while there are so many restrictions around? Driss, you want to comment?
Sure. So Deka itself had already started or founded an office in New York back in 2008, which was actually focusing only on the lending business. And in 2013, we opened or established a Deka entity also in New York, who joined then the same office from the equity platform. So we do have a team based in New York, which is myself and some more people in the acquisition team, as well as in our asset management. And we do actually run our acquisition process out of New York with a team back here in Germany. So when it comes to touring opportunities or seeing investments, we are not affected by this current travel ban. Of course, some of our people here in Germany who had maybe toured some assets before we executed a contract may not be able to do so, but this was not a requirement back then and is not today. The only issue or impact we had was, in fact, given that we are highly regulated under the German Investment Act, or the KAGB, we had the requirement to have a appraisal before executing a PSA, which was conducted by a German appraiser, certified and qualified under the German law. And of course, the first thing we did after the travel ban, we checked our portfolio if we may have a US citizen appraiser, which would have been maybe his moment right now and could done all our deals in the US. Unfortunately, this was not the case. We got in touch very early with the German BaFin, the supervisory authority in Germany, and explained to them the situation. And we also found a way to restructure this requirement, whereas we got final approval from the authority to use local advisors and appraisers, such as the big 5 firms. And therefore, this requirement, which we had so far, we could solve immediately, because back then we already saw the opportunity or the threat that this travel ban may actually last not only a couple of days or weeks, but a couple of months. And therefore, we were able to do those transactions, which I meant earlier, also in other countries. And for example, we just closed recently on a large transaction in Australia during a hard lockdown. And this was only able because we could benefit from having access to local appraisers and having the approval from the supervisory authority that we can apply those appraisals for our acquisitions. And therefore, the travel ban right now, I would say, does not really impact our ability to invest neither in the US nor in any other country.
Okay, and Rainer, for you, you are obviously have issues in terms of traveling now to the US, obviously, and to view properties not only in the US but probably around the globe. How do you deal with that? Do you have local partners with whom you're dealing with, or?
Yeah, definitely. I think like as of today, I think the whole team, which is like 18 people, did like 2 business trips, one to Frankfurt and one to Paris, and that's it for this year. So we've been pretty busy. Now, to be fair, the travel ban is a real issue for us, because normally, yes, of course, we do operate and collaborate through managers, and of course, the managers are our eyes and our ears on the ground. But nevertheless, of course, we always do a site inspection, and we like to see the asset we are going to buy. And that's something that came to a full standstill. Of course, we do work with proxies like drone videos, live streaming, tons of pictures. Nevertheless, it's not perfect for us, to be fair. And that's probably the reason why we just did like 2 or 3 transactions, mainly in locations, and that's probably the advantage of the team, as we are having people in the team who have 20+ years experience also in foreign markets, to really know the locations. Probably we have been in the building, and that's something that really helps. But of course, we're looking forward to the end of the travel ban, as we really like to see the assets. And due to that, I think we're definitely much slower than we'd like to be.
Okay. And in terms of capital, I mean, Robert, you already explained that obviously there's a lot of dry powder, domestic dry powder. How do you see, currently international investment coming into the US? So in terms of capital, is that dominated by US capital, or do you see a lot of international capital coming back? China was obviously off for quite a while. How do you see that developing?
When it comes to German capital, I think there is a clear spot and a competitive advantage. We are under attack by domestic players on the buy side. Yeah, they're aggressive. At the end, we've been in transactions where I would say we're below 1% behind the number 1 and number 2. That's how they play it out. We went through transactions where the bidding process was reopened after the second round to what we believe is the worst outcome on the buy side, a sealed bid, which is pretty much like soccer, like penalty shooting. You had a great game, and then the first miss and you're out. We had this as a tough experience for an advisor, because everything goes for nothing. Yeah, I mean, in the past, everyone talked about the Asian capital, which I think is more disciplined than it used to be. China, based on the regulations, is not really a big player. Yes, there is high net worth capital out here, especially Hong Kong. We see cash flow driven long-term investors from Korea, which are competitive, but they are also sliding on the capital scale from the equity to the mass to the debt side, right where their risk return profile is fitting, and it's less the real estate, it's more the return profile. So we see them on both sides active. I think for Deka's advantage here, having that BaFin agreement, I definitely see Deka has a competitive advantage to other open-ended funds. Having a dollar-dominated fund, definitely also an advantage. Not as much as 6 months ago when the hedging costs were twice as high. But we see on deals, if it's a core deal, and to Triss's comment, if I have leasing activity during my hold, if I have a rollover first 5, 6, 7 years especially, I need to factor in an environment which does not foresee rent growth. We go way more into depth into balance sheet analysis of tenants, which we would have winged through in the past to see what if. The what if scenario is a big one, and are way more cautious. But I would say this goes with the domestic competition too. At the end, it's a little bit, you need some luck at the end to make it, as you get very close together, and it's not the environment yet which we're waiting for, and I touched on during my presentation, where you see too many off-market deals, as it does not really make sense. If you have core product, why not going out there and have it go through an auction where I might get a little more? Here and there, it's more saving of face. Institutions don't want to be seen as a seller. That's the opportunity we see here and there, and we're talking actively with a couple of institutions. But with that, it's a very competitive environment where core deals with long-term credit tenants don't have a discount. We're talking about a COVID premium.
Driss, what's your Deka view on upcoming election? Does that at all affect your strategy for the US, or is that something you consider at the moment, or are you just looking at history in terms of real estate markets have developed with Democrats and with Republicans?
I would say the latter. So first, it's hard to underwrite. So we don't know exactly who's going to win, and then secondly, on top of that, it's not only who's going to win the elections, also who's going to win the House and the Senate. So obviously, we do also, in fact, watch very carefully the different approaches both have, in fact, and try to understand what this can mean for our fund and our investments. But given that we already had a couple of different presidents and majorities in the Senate in the past, we do not underwrite this risk as being a mid and actually a long-term investor. And also looking back to the history and maybe also looking to the capital markets, we did once a very interesting analysis showing that in the last 28 elections, they were, for example, only 4 times the fact when the stock market actually was in the year of the election was not very much positive, which was once in 1932, just right after the recession, 1940, which was right after the Second World War. We had 2000, which was right after the tech bubble, and in 2008, just right after the financial crisis. And we have also seen that, for example, over the last 100 years, you can see that the performance of the capital market was in the post-year election, post-year after the election was actually much better than the year during the election. And given this trend in the past, we do see and try to understand the impact of a election, but given that we are a long-term investor, maybe not as a pension fund and as a church, as Rainer said. However, we do believe in the long-term approach, and therefore we are much confident.
Rainer, you already said something in terms of your time horizon in terms of investment strategy, but any comments to upcoming elections and obviously House and Senate?
I think we take it like it comes. That there's like no way to deal or to influence. And with a really long-term view, I think we will see a couple of more U.S. presidents. And our time horizon, as I said, is very long-term. Of course, we might see any volatility on a short term, but on a long-term view, I think it's we can amend that.
Okay, so thank you, Rainer. Jana, you're back. So we are quite interested to hear questions from the forum. Yeah, so if you want to shoot off, yeah, then that would be great.
Definitely. Well, you were already psychic and anticipated one of the questions that was on the topic of the elections, but maybe a follow-up on that. Over here, we had a situation that one investor actually wanted to go a bit more green and had difficulties convincing all stakeholders in the process. How do you feel about this whole black box process that the politics in the US are currently going through? Does that influence the let's say the sentiment of German investors who are obviously your clientele? And do you have to convince them? Is that something that you're experiencing, or are they simply following your long-term perspective at the moment? Maybe Driss, do you want to start?
Sure. So we are not, or as Deka and Deka Bank, as being we call ourselves the Wertpapierhaus of the Sparkassen. We are not only invested in the US through the real estate. So we do have also many other units of our bank balance sheet as a lender, but also the capital market invested in the US. So when it comes to investments in the US itself, we don't have only a real estate focus. This is a opinion which we have throughout our entire group, and therefore we don't really or let's go this way. We actually follow the entire trend of our entire group. Do we believe in the US long term? Do we believe in the economy long term? Yes. And as long as we do so, and our history, even if it's only close to 30 years in the US, has proven that we should not react very immediately and ad hoc when it comes to any matters or items happening right now in the US. Is it a financial crisis, 2008, where in fact we actually turned around in 2009 and started to do one of our best investments, which we did in 2009, 2010, 2011, when people reached out to us and said, "What the hell are you doing? Why do you buy right now assets in the US?" Turned out that every investment we did back then in 2009, 2010, and 2011 turned out to be the outperformer in our portfolio. And therefore, as long as there is a strategy in our entire group that we do believe in long-term and mid-term in the US throughout our platform when it comes to capital markets and bonds and real estate, there won't be any major changes. And therefore, it's not really hard to convince our board when it comes to particular real estate investments.
Yeah, so the question is, when do you actually invest, not if. Right, cool. Thanks for that statement. Anna, would you like to add something, or should I maybe add another follow-up? Because one participant was asking on the topic of why the US market is so interesting, if it is maybe more transparent than German markets, and might that make deals abroad easier, especially for a new starter? Would you like to incorporate that into your answer?
So yeah, definitely. So my personal view, I definitely like markets which are more or which are less transparent and opaque, because these markets definitely deliver, if they have the appropriate network, the better deals. So full-blown transparent markets for less sophisticated investors, definitely a good start. Personal view, I'm a big fan of more opaque and not really transparent market, because it's a really pain if everything is like full transparent regarding from the press to the deal to everything. It's really hard to differentiate there.
That's a very good point, and I think is supported by the discussion we had about industrial. Industrial has transparency, is a quick market, and to your point, Rainer, it's extremely hard, and you have to be careful what you wish for. Transparency comes with competition, and at the end, the one who pays the most gets the deal. There's nothing else you can do. So,
not a really sophisticated model.
Very American concept, equality of opportunity, isn't it?
Yeah.
The next question, residential that we discussed in Asia and Australia this morning, actually becoming more prominent. Would you say, and obviously in EMEA it is already a long-term successful product, would you say that maybe in the US, given the experiences of 2008, it's a bit of an individualistic different situation than it is in the rest of the global scale? Robert, would you care to take that question?
Thank you. As an office specialist, thank you very much. I would say the difference is that housing is extremely expensive in the US, especially in the metropolitan area. It's a trend, as I said before, that there's a shortage of affordable housing. we see actually a trend. I mean, there are a couple of trends which don't make so much sense, but the metropolitan areas have a steep incline in value appreciation on residential real estate. Is it because people have time to think about the new home right now, sitting at home? Is it clearly the record low mortgage market, which makes it very attractive? But the market is extremely hot, and even the jumbo loan sector, which I'm sure everyone is familiar with, this is, I think, mortgages over 750 up to 800,000 higher, which is always a challenging market. Even that sector, where we saw a year ago stocks sitting longer than before in average, is trading extremely aggressively, especially in the coastal metropolitan areas.
Mm-hmm. Actually, that leads quite nicely back to another topic we had earlier on when you were in the office sphere talking about opportunities in Australia. Driss, actually, one of the participants is asking, what is the major difference for you between the Australian market, for instance, and the US market? Is it only size?
I don't have our portfolio in Australia right now in mind, but I would say that let's take Australia and New Zealand. It's not that much smaller than in the US, but certainly size is one matter. So when you look at the US, and given that we are invested in, we call them the gateway cities. So on the East Coast, it's New York, Boston, and DC. Let's get over to Chicago, and then we are also invested in Portland. Look at Seattle, San Francisco, and LA. We do have much more opportunities, and every single state you can actually consider almost as its own country. And when you look at Australia, there's not much comparable opportunities or cities as in the US. So therefore, I would say size-wise, we are pretty much and well invested in the Australia. Would Australia become a competition to the US? I don't think so. Given the lack of markets, and therefore I would agree and put this, without speaking for my colleagues or my colleague in Singapore, I would agree and argue that because of size, we are not as much invested in Australia as in the US.
Thank you. Maybe one last question to give to the whole panel. In Germany, we've had a polycentric structure for decades, and our cities, particularly the ones that are home of universities, have performed very well in the past years. Now, the US is famous for its fabulous university structure. Would someone starting anew be well advised to actually follow the Berkeleys and MITs of the US? Mr. Komenda, Rainer, would you like to start?
Yeah, definitely. I think universities are a big industry in the US and definitely driving also the markets, also for reasons of diversification. I think life science came in really prominent as one of the newer segments or asset classes, and that's probably something which is definitely attached to research and development at the universities. And I'm a big believer of these, not only of these super prominent names like Boston, but there's a couple of mid-scale cities like probably Austin, which is also very important to the US. So definitely, if you'd ask me, of course, yeah.
That's just my bias. I love Boston, but yeah. Right. Okay. Anyone else care to comment on that question? Otherwise, I would hand on to Matthias for the wrap up.
Excellent. So I think in terms of we're doing the tour around the world in terms of seeing where we stand at the moment. I think when covering the US, I believe the US, because of the situation there, which is still a little bit behind in terms of clarity on where COVID impact really impacts the whole economy. I think people in real estate still see and watch the market very carefully. Yeah, And the good news is that hedging costs obviously have been improving. So for foreign investors, this is certainly something which certainly makes a lot of sense for those who don't care anyhow. So if you are long-term investors, that is just a blip in the market, and it doesn't affect your general investment strategy. Certainly, I think for having a portfolio, a global portfolio, you need to be invested in the US because you really have, grade A, quite an important portion of grade A product there, and as we might see from Germany, the election is not so much a topic really when investing in real estate there. So I think that's for me clearly the outcome of this webinar today, and it looks as if you continue to be firm on your strategies going ahead in the US. So thank you for your time.
Yeah, thank you from my end as well. Everyone, it's been an interesting debate, and thank you also to the audience for your valuable questions that you contributed to this exchange. It's been lovely having you, and I'm very much looking forward to our next digital talk tomorrow morning at 10 a.m. CET. You would like to know what's next? Well, Matthias and I will go on our journey around the globe furthermore, and our next stop is EMEA. Here, the events of 2020 have reinforced the trend that European core markets are developing in different directions. London, Paris, and Berlin are good examples, and we want to ask the question, what will happen in the next months? Which investment destinations have been able to sharpen their profile as safe havens, while others struggle with the new conditions? Matthias Leube and I will welcome together Ali D. Ottmer, Senior Partner and Deputy Head of Investments at Tristan Capital Partners, as well as Philippe Lapierre, CEO and CIO Continental Europe at La Salle Investment Management. I'm very much looking forward to this. I'm wishing you all a very good evening on the European side and a very nice end of working day on the US side. I'll see you in the live stream at 10 a.m. CET tomorrow, and yeah, have a good day. Bye.
All the best. Thank you. Bye-bye.
Thank you, everybody. Bye-bye.